In today's mobile society, it is increasingly common for our courts to deal with international divorce cases and the complex tax issues they present. These cases may involve spouses who are resident aliens, maintain offshore assets, or earn income across global boundaries. Chapter 21 of my book specifically deals with offshore accounts in international divorce cases. Prior to the age of electronic banking and the internet, it was possible to maintain offshore bank accounts privately in tax haven countries, sometimes without reporting them to the IRS or a spouse. Today, tax enforcement is more rigorous, and the concealment of offshore accounts is more difficult and risky. The IRS requires disclosure under the Bank Secrecy Act of 1970, which has been amended several times. Financial penalties and incarceration are the possible consequences of a taxpayer's failure to disclose offshore accounts. Still, the risk can be lessened by voluntary disclosure. In divorces where foreign bank assets are implicated, tax-related responsibilities between the parties may become the largest financial issue in the case. Any U.S. citizen or resident having a financial interest, even signatory authority, in a financial account located outside of the United States must file an IRS report of foreign bank and financial accounts, Form 114, commonly referred to as the FBAR. That is, if the aggregate value of all accounts exceeded $10,000 at any time during the calendar year. The willful failure to do so is a felony. The FBAR is not a tax return. It's a Treasury information form that is filed with the IRS by mail or by hand carrying it to any local IRS office. The financial accounts covered by the form include cash accounts, certificates of deposit, investment securities, and other financial interests. Signatory authority is broadly interpreted to include anyone having the power to use or direct the use of the funds in the account. The FBAR is due June 30 of the trailing year with no extensions allowed. Electronic filing is available through FinCEN's BSA e-filing system. Compliance with the FBAR filing requirements is monitored through questions on the 1040 tax return, Schedule B, which asks, at any time during the year, did you have a financial interest in or signatory authority over a financial account such as a bank account, securities account, or brokerage account in a foreign country? A yes answer requires the filing of an FBAR Form 114 unless one of the exceptions should apply. A false no answer on the tax return can be grounds for a tax perjury or evasion charge. Failure to file the FBAR is subject to harsh penalties and felony criminal charges. The civil penalties for failure to file may include up to $10,000 per incident if non-willful, but there's a reasonable cause exception, or up to $100,000 or 50% of the balance in the account if the failure to file is willful. Willful means the intentional violation of a known legal duty. In other words, the intentional failure to file the FBAR or the intentional filing of a false FBAR. These penalties are cumulative. So, for example, the willful penalty could theoretically grab 50% per year of each offshore account, subject to constitutional limitations for excess penalties. In either case, the IRS may assert some lesser penalty depending on mitigating factors, such as no prior history of FBAR violations, taxpayer cooperation, or the IRS failure to assert a penalty as to any income tax underreported relating to the account. The Treasury has up to 6 years to assess the civil penalty, plus, after assessment, 2 more years to sue for recovery of the penalty. The threat of financial penalties and felony conviction should be a powerful deterrent against intentional concealment of offshore accounts, but unfortunately, it is not. In recent years, the IRS has rolled out several amnesty programs offering reduced penalties for voluntary disclosure. Chapter 21 describes some of the offshore voluntary disclosure programs, OVDPs, and their requirements. If you are involved in an international divorce and suspect or know that an offshore account exists, what do you do? First, serve discovery to investigate the existence and magnitude of the offshore accounts. You can check Schedule B of the federal income tax return, but you must also ask for a copy of the FBAR forms. Your standard document request might not cover this, so be sure to include it in your next request. Next, if you learn that no FBAR form was filed or that a false FBAR was filed, consider who might be liable for non-disclosure penalties and criminal charges. A spouse who has signatory authority can be held liable, and spouses sign financial documents often without reading or remembering them. Finally, consider one of the voluntary disclosure programs if it might offer reduced penalties, and then be sure to allocate those liabilities in the division of property and debts. For family law help in Western Pennsylvania, call me. I'm Brian Virts, and for more than 25 years, I've represented all kinds of people with complicated child support and divorce issues. My law firm is a powerful team of lawyers dedicated to family law. In Pittsburgh and Western Pennsylvania, call me at 412-471-9000.